Hello, CQA competition. My name is Mac. I am going to be introducing our competition submission. We are from Carnegie Mellon, and we are going to present our portfolio performance and findings based off of the prompt. So this is the presentation agenda. We're going to go through the investment team. Once we introduce ourselves formally, we will go through into the portfolio strategy and construction. Then we will talk about our performance. We'll talk about the analysis of the returns that our portfolio gathered, and then finally lessons learned based off of the last, call it 5 months of learning about the positions that we made, making some insightful decisions, and digesting everything that's happened in the market since. So this is our investment team. We're 5 first-year MBA students at Carnegie Mellon. Matt Ryan, Jaime Limon, Delina Peng, Jing Gao, and myself, Mac Trainer. We will each take one of the agenda topics to discuss, and you will hear from each of us accordingly. I'm going to kick it over now to Matt to discuss the portfolio strategy that we implemented.
Yep. So here our main goal is to maximize the Sharpe ratio of a diversified long-short equity portfolio. So for our portfolio strategy, we devised a different type of approach to the usual market neutral or long short style fund composition. We instead devised a pairs trading strategy based upon fundamental analysis by industry group. So we split up into 5 groups with the industries as follows: myself being the industrials and materials lead, Mac being the energy and real estate, Jelena being financials and technology, Jing with being healthcare and communications, and Jaime being consumer goods, discretionary and non-discretionary. So a little bit more about our portfolio strategy. So like I mentioned earlier, we did a pairs trading strategy based upon companies in each industry, but left some flexibility up to each analyst. In some cases, an analyst could long 2 stocks at 1% of the portfolio each and short 1 stock at 2%. So that's why we have a different number of longs and shorts in our portfolio. We made this decision to split the portfolio by manager as it allows for less managerial bias to not overtake the overall fund. Each analyst could then make their own decisions on portfolio construction. So one example is for myself with what I did with the industrials and materials section of our portfolio. It had both a positive value factor and positive side factor. And this is done through a screener that I first used. On the long side, we looked for forward PE ratios for the next 3 years of less than 25. And then we also look for price to forward cash flow per share for the next 2 years at less than 15, a PEG ratio that's less than 1.25, and a high credit rating. So then throughout our whole portfolio, we adjusted positions over time by keeping around 0.75% to 2.5% per stock, just going through the portfolio on a monthly basis. And we would reevaluate each stock when it gets outside of this percentage range. So we'd either rebalance or close the trade. So next, I'll kick it off to Jing for our portfolio construction.
Yeah, for the entire time period, the portfolio consists of 69 long positions and 51 short positions, with a total market value of 1,886,358. The portfolio biased towards long positions with a weight of 54.4%, and the short positions with a weight of 45.6%. The current open positions in the portfolio consist of 52 long positions and 46 short positions. The portfolio is biased towards long positions with a weight of 51.6% and the short positions with a weight of 48.4%. The market capitalization weights in the portfolio are as follows: the 9.6% small cap, 28% mid cap, and about 61% large cap. The portfolio mainly focuses on large cap companies, and the portfolio includes long and short positions in about 16 sectors. Within this, the financials, technology, and the health sectors have a large weighting in the portfolio. In summary, we build a portfolio based on economic conditions, diversifications, and historical performance of stocks, aiming to diversify risks and achieve returns. And for the performance analyzing, the total performance of the portfolio shows a negative performance of negative 0.9%. On the other hand, the performance of open positions shows a profit of $20,469, which presents a positive performance of 5.6%. This means that our team made profitable investment decisions on open positions during this period, which offset some of the losses incurred by the closed positions. Analyzing the individual positions, there are a mix of long and short positions. Among the lower positions, Meta stands out with a gain of 134.5%, and the Lim Batch with a gain of about 99%. The biggest loss among the long positions is Sandridge Energy with a loss of 23%. Among the short positions, the biggest gain is in Wildcrop with a gain of 41%, and the biggest loss is in Abercrombie and Fitch with a loss of about 69%. By calculating the 5 months standard deviation, we obtain that the portfolio's return is less volatile than that of the benchmark. Based on the correlation is negative 0.44, indicating a weak negative correlation between the portfolio and the S&P 500. The portfolio has the advantage of diversification. Overall, the portfolio has a mix of gains and losses, with the long positions performing slightly better than the short positions. And the portfolio is also well diversified with a mix of long and short positions across different sectors.
Thank you, Jing. I wanted to touch quickly on a bit of the risk on the portfolio. I do want to lead with a disclaimer that given what we had with the issues on the reporting, that the numbers might seem slightly off, but however, we feel that they're directionally correct. And one of the things I wanted to point out is that since we had a beta of negative 0.24, the market sensitivity was something that really came out of this risk analysis that we were doing on the portfolio, given the reports provided by CQA. What was also interesting is how information technology, given that Meta was a leader in our portfolio, correlated well with the active risk shown on the right-hand side, where the sectors by asset aggregation was showing up correctly. What's also interesting to note was that we were trying to have a portfolio that was less correlated with the market, and we can see that the volatility down to the style factors was also a small percentage given the active style exposure given by the reports provided by CQA. In terms of the risk composition, we had 2/3 of a factor risk and also a 1/3 specific risk, given that the market was really volatile during the competition. These were correctionally right analysis by the reports. And I wanted to kick it off to Jelena.
Thank you, Jaime. So in conclusion, our portfolio achieved a somewhat non-satisfying result with an absolute return of negative 2.17%, a Sharpe ratio of negative 0.73, and a beta of negative 0.24. We conclude 2 ways to improve our portfolio. First, a market neutral portfolio should be market neutral. We implicitly took a view of the market's direction, which came back to bite us. We could make more adjustments to make the beta as close to 0 as possible. The second thing is that our portfolio's performance is not good as expected. The positive market movements negatively impacted our portfolio return. We could increase our portfolio's volatility to reach a higher expected return. However, we do think there's one thing we did well for our portfolio is that we emphasized on the portfolio compliance and monitor our coding positions at the end of each week. And we are the only team that achieved 0 demerit points. So thank you very much for your time. We appreciate CQA hosting this event, and it has been a great learning experience.